Hey everybody, we've got a number of folks still dialing in, so we'll get started here in a minute. All right, we've got a lot to cover, so let's get started. Good afternoon, everybody, and welcome. I'm Jake Wolf, General Counsel at Crux, which is the capital markets technology company changing the way clean energy and manufacturing projects are financed in the US. We're here to unpack the House Ways and Means Committee's proposed changes to energy and manufacturing tax credits, which have evolved over the course of the last week and continue to do so as we speak. We'll start by setting the scene and talking about where we are today in the legislative process. We'll then dig into some of the bill's provisions in a bit more detail, including discussing how the provisions may be changing before looking ahead to what's next. Finally, we'll leave time at the end for questions. Please drop all questions in the Q&A window, and we'll discuss as many as possible. Before we begin, a couple housekeeping notes. First, this event is off the record for any members of the media. And second, a recording of this webinar will be sent to all attendees after the event concludes. Now, I'm pleased to introduce our panelists. Hilary Lefko is a partner at Norton Rose Fulbright in Washington, D.C., where she focuses her practice on all areas of federal income tax law, with a particular emphasis on renewable energy and project finance tax issues. She represents developers, lenders, and investors in various energy and renewable energy projects, including transactions involving Section 45 production tax credits, Section 48 investment tax credits, and other renewable energy incentives. David Skillman is a partner in the Public Policy and Law Practice Group at K&L Gates. He regularly advises clients seeking federal legal, regulatory, and legislative changes, particularly at the nexus of tax and trade policy. Prior to joining K&L Gates, David worked for over a decade as Deputy Chief of Staff and Counsel to a senior member of the House Ways and Means Committee, where he worked on, among other things, legislation supporting renewable energy incentives. Joe Boddicker serves as counsel in the federal and international tax group at Alston and Bird. He focuses his practice on tax, legislative, and public policy matters, with extensive experience advising on corporate, partnership, and energy tax issues. Prior to joining Alston and Bird, Joe served as a law clerk in the United States Tax Court and as tax counsel for the U.S. Senate Finance Committee and Majority Leader John Thune. Alfred Johnson is the co-founder and CEO of Crux. Before founding Crux, Alfred served as Deputy Chief of Staff at the U.S. Treasury. Prior to Treasury, Alfred was co-founder and CEO of Mobilize through the company's acquisition in 2020. Earlier in his career, he held senior roles at BlackRock, the U.S. Treasury, and the White House. So let's dive into the discussion. We have a lot to talk about. David and Joe, I'm going to come to you in a minute on the legislative state of play. But to set the foundation, let's start with talking high level about the proposed legislation from May 12th, which includes a few categories of changes that we want to highlight today. So first, the proposal would fully repeal several clean energy credits by the end of this year, including credits for residential clean energy systems and EVs, as well as the clean hydrogen production tax credit. Next, the tech neutral PTC and ITC, along with the nuclear production tax credit, would begin phasing down in 2029 and be eliminated by 2032. Third, the ability to transfer credits would remain in place through 2027. Starting in 2028, transferability would be repealed for most taxpayers, though would continue to be available for tech-neutral projects that begin construction prior to that time. And finally, new foreign entity of concern, or FEOC rules, would limit eligibility for tax credits where project components or ownership involve entities deemed foreign entities of concern, with application across many credits. So David, I'll come to you first. I know things are very fluid at the moment. Can you explain where we are in terms of the legislative timeline for this bill? What's happened so far in the House, and what is the current state of play for the legislation, particularly among House Republicans?
Thanks, Jake, and nice to see everybody. The reconciliation bill and the process under which these tax changes would be enacted is fundamentally a two-step process. One, the House and the Senate must pass a budget resolution that sets forth certain broad fiscal parameters for the substantive legislation. That has been done. Pursuant to that resolution, committees are then instructed to meet certain fiscal targets with respect to the overall fiscal outline of that bill, advance their respective targets. Those are then bundled up by the budget committees, sent to the respective floor of their chambers, enacted. And that is a give and take like traditional legislation between the House and the Senate. We're midway through the first step of that process. So the budget resolution has been enacted. It has sent instructions to the Ways and Means Committee, which in the House has jurisdiction over tax measures. The Ways and Means Committee has marked up and advanced its portion of those instructions, which include significant changes, those outlined by Jake, that many of you are probably well aware of, out of the committee in a very long and contentious markup process. And the Budget Committee has bundled those changes together with other relevant committees in the House into a single piece of legislation. And that legislation is now at the Rules Committee, which is a special committee in the House that governs the way legislation is treated on the floor of the House for purposes of advancing out of the chamber. That's where we are right now. There are a number of different factors that have influenced this process as it advances. Because of the way that the reconciliation process sets itself up, it is almost wholly a partisan process, meaning that if Democrats were in charge, they could use reconciliation, but it would rely only on Democratic votes. Here we have Republicans in the majority, and they're going to rely on solely on Republican votes to advance this legislation, both in the House and in the Senate. And because the chamber's margins of control are extraordinarily narrow, Republicans in the House effectively need to maintain unanimity on the underlying bill. And that puts in tension many different factions, many people's districts that are unlike one another. And so we've seen that play out for purposes of advancing this particular bill. For instance, many Republicans that are in the House of Representatives represent districts where a large portion of the population is on Medicaid, where rural health providers rely on Medicaid for purposes of providing health services and so forth. And the underlying bill significantly reduces Medicaid benefits, adds other requirements. They have concerns about the scope and scale of those Medicaid cuts. Other factions are from high tax state districts, and they are seeking changes to the state and local tax deduction. It does seem like there's been some movement on a deal with respect to SALT, as it's known, that would mollify some of those key members. And then third, there are a large number of Republican districts that have seen a tremendous influx of investment pursuant to the clean energy tax credit incentives, or clean energy incentives that are concerned about aggressive reduction of those incentive packages that makes them unwilling to vote for some of the more drastic proposals that are out there. This interplay of sort of an overlapping Venn diagram of these three major groups has held up consideration of the bill. On the other side of these groups has been the very conservative faction of the House Republicans, the House Freedom Caucus. They are demanding even further cuts. And so we're sort of on a policy teeter-totter where the far right of the House conference wants additional cuts. the sort of more moderate or the factions, with respect to those particular camps, want to preserve some of those programs. And so you can't affect one without affecting the other. And that's been the challenge that the House has faced in this whole transaction. And because the legislation is now specific in terms of making those decisions, these challenges have come to the fore, and we are not able to advance the bill out of the Rules Committee, absent one or many of these members making a deal and coming to terms with the base text. So Rules began meeting early this morning at 1 a.m. They worked their way through the various committees of jurisdiction. They heard some 500 Democratic amendments. As of about mid-morning, it became clear that there weren't the votes on the underlying package because of this dynamic. The chair of the House Freedom Caucus, Andy Harris, has indicated that he doesn't believe the legislation can advance on Thursday, or by Thursday of this week. And it has been announced that there will be a meeting between members of the Freedom Caucus and the president sometime this afternoon to attempt to resolve this impasse. That's where we're at with purposes of the legislation. Should that be achieved, the House will vote in short order, probably a motion to recommit, but basically few procedural hurdles. The House will vote. Presumably, they have a deal with the Republican caucus conference writ large and advance that legislation over to the Senate, where a similar set of negotiations may take place. And we'll talk about that, I think, in a look ahead section later on.
Great. Thanks, David. I think that's a good segue over to Joe, who is our Senate expert on the panel. So, Joe, we've heard a lot about the Senate being a potential moderating force for the legislation. You've worked at Senate Finance, you know Leader Thune. What are the dynamics in the Senate that could alter the trajectory of this bill, particularly with respect to the energy credits? And can you also talk about what, if anything, has happened so far on the Senate side?
Yeah, I'd be glad to. The Senate has long been regarded as sort of the saucer in which the House's hot tea cools, and I think that is especially true today. If we look back to 2017, just to do a brief history lesson, right? The original tax cuts passed under Trump didn't contemplate any energy tax changes. That was because such changes were thought to be too divisive among Republicans, right? Yet fast forward here to 2025, and congressional Republicans are considering clawing back large portions of the energy tax credits and attempting to do so with an even slimmer majority in the House than they had in 2017, as David pointed out. And so I think setting the stage there, it's a very difficult environment to even progress, and we're seeing a lot of that play out over the past few days in the House. Now, unlike House Republicans, Senate Republicans have never been as hostile to renewable energy tax incentives. Many Republican senators, including Finance Committee Republicans, represent states that have benefited significantly from renewable energy investment. We have that recent letter where you had 4 Republicans sign on, 4 Republican senators, including Senator Tom Tillis, whose seat is thought to be the most at risk in the next election, signaling to Senate leadership that ultimately we need to take a soft touch here, right? And we may need to soften, based on sort of the parameters they've outlined in the letter, soften the approach taken by the House. And so while Republicans have unified control government and a slightly larger majority in the Senate this time around, right, they can't afford to lose 4 Republican senators, right? That would be ultimately fatal to the bill. And so that'll be a major factor in sort of softening as well. Senate Republicans don't have the same pay-for pressures. Most of them, including the majority leader and Finance Committee Chairman Crapo, want to use current policy baseline to help offset the costs of TCJA extension or extension of the expired and expiring provisions. And so their approach, if successful, will take significant pressure off of other potential pay for such as IRA repealed. That said, there is growing concern, especially with the recent downgrade by Moody's of the US's credit rating, that ultimately some of these fiscal concerns cannot be continue to be neglected, that ultimately they need to be addressed. Sort of in favor also of a softening of this approach. Senate Republicans care a lot about getting the policy right. They widely recognize the potential impacts on consumers from utility price hikes, disruption to business investments that have already been made. And I think they'll want to really think through some of the issues presented by the language that we've seen today. They will also want to take a close look at phase outs, the foreign entity of concern restrictions, which I know we'll get into later on. But I think they're going to, at the end of the day, want to ensure whatever is done is workable. And then the last thing I'll point to is, what is the real deadline, right? Some of the starts and stops that we're seeing today are being driven in part by an artificial deadline that was created by the speaker to help accelerate passage through the House. Now, everyone works better under a deadline, but most people think the first real deadline isn't until August 2025, right? When we hit our so-called X date, where Treasury will exhaust the extraordinary measures it can use to manage the debt ceiling. And so I think the Senate especially is aware of that, and they know that they'll have through the summer, or at least till August, recess to work on this. And so depending on when this bill emerges from the House, the Senate really may sit on it and take its time to make sure it gets things right. And to the extent that it does have that time, I think that will also impact the process that the bill receives by the Senate, whether or not that's full committee markups, or if that's just straight to the floor and more of a leadership driven product. In terms of, just to hit also on your last question, process to date, we had these sort of closed door meetings through the dating back almost a year now, talking through proposed changes. So the Senate has at least been providing a forum for members to discuss changes, for certain stakeholders to come in and discuss those changes, but there hasn't been a lot of public facing sort of discussion or debate to date.
Great. Alfred, I'll come to you next. Clearly a lot happening on the Hill. And you're a careful observer of the policy developments, but also spend a lot of time operating within the clean energy market. Can you give us a sense for the reaction that we've seen from the market on the developments to date?
Yeah, Jake, this is a extraordinarily complex set of legislative dynamics that the House and Senate are trying to manage, and they're trying to do it extremely quickly. So I don't think it's possible to overstate how fluid the situation is, right? We have some text that came out of the Ways and Means Committee. It is going through rules right now. There is a meeting that is presumed to happen this afternoon between the House Freedom Caucus and President Trump. We are awaiting text on a so-called manager's amendment that would change the legislation for consideration by the full House, and presumably they are going to try to do that within the next 2 days. The legislation would impact the fundamental treatment of Medicaid, the way in which taxation happens in a number of states that are highly dependent on relief on the SALT deduction, and clean energy that has cascading impacts to communities all across the country. So a lot of stuff is happening. It's happening fast. It'll then go to the Senate that will put their own mark on the legislation. And that is the broader context that covers this market within which we all operate, where transferable tax credits are the principal way in which the benefits from the Inflation Reduction Act are extended into developers and manufacturers across the country. They became transferable in early 23. The market has accelerated quite quickly. We estimated that about $30 billion of transfers happened in 2024, and the market continues to operate pretty well in 2025. I think one of the real benefits, surprises to the upside of the way that the IRA was constructed was that it took all of these tax credits, many of which had existed before, some of which were new, and created this new well-functioning market on top of them or with them. And what I'd observe about the present market is there are a number of dynamics that make different credits within that market trade somewhat differently. PTCs generally trade at a premium to ITCs, so production tax credits at a premium to investment tax credits. Larger deals price better than smaller ones. Demand for current year tax credits is worst in the first quarter of that year and best in the first quarter of the following year. And new credits like advanced manufacturing credits, nuclear credits are increasingly making up a larger share of the market. All of those points, Jake, are operative today. So PTC pricing today is at about 95 cents gross on average. ITC pricing is between 92 and 94 cents gross on average. The impact is larger on ITCs. In the smaller ITCs get a lower price than the much larger ITCs. PTCs have a much flatter curve where smaller PTCs price closer to larger PTCs. And the market is really starting to pick up now for 25, but remains extremely strong on 24s. On Crux, we are currently observing about $4 of demand for every investment tax credit, 2024 investment tax credit that is on the platform. We see about $9 of demand for every production tax credit that's on the platform. And that is not quite as strong yet on 2025 credits. The market is just starting to develop on that. I think to answer your question most narrowly and specifically regarding policy, the more the policy environment appears chaotic, the less certainty that people have about whether the credits will be earned in the future, what tax liabilities will be on the corporate side in the future. Uncertainty is always the enemy of a well-functioning market. And so I think it is plausible that as this advances, there is more uncertainty. It's also plausible that we see more certainty in segments of the market. For example, the Ways and Means text does not contemplate retroactive tax law changes, which would be by far the worst thing that could happen to the market. In that way, if that kind of treatment finds its way out of the House, then it can be presumed that 2025 credits are safe, for example. And you may then see a run on 2025 credits where there is all of a sudden a lot more demand for it. So all of that highlights how the market is operating in light of a very fluid policy and regulatory environment.
Great. Thanks, Alfred. So we've sort of set the stage. Let's jump into the bill's provisions and highlight a few of those in a bit more detail. So Hilary, I'll come over to you. As I mentioned, there are various credits receiving different treatment and phase-out periods. I know you do a lot of work on the developer side, many of whom utilize the tech-neutral ITCs and PTCs. Could you provide some more detail on how the phase-out schedules are intended to work for 45Y and 48E, and how your developer clients might be starting to think through those impacts in terms of their investment decisions?
Sure. So what I think that, one thing that we've seen is the phase out for the tech neutral credits is proposed as a placed in service standard. It would affect any project that is placed in service after 2028. And we'll get into the implications of this a little bit later, but that's a departure from the previous language, which had a begun construction standard. That means the developers are going to be trying to get their projects in service by the end of 2028 to avoid the phase down. The phase down hits 20% each year. So if you place a project in service in 2029, your tax credits, including any bonus credits, would be reduced by 80%. There's a little bit of a mismatch, though, because the transferability repeal is based on a begun construction standard. So if projects don't begin construction by, and we're using kind of that August X date or prior to August recess as a guess of when this may pass, they don't start construction, say, August 2027, they're not going to be able to sell their tax credits. So I think what we're looking at is a decision-making process where you're kind of losing what you would have otherwise had as a 4-year continuity period if you start construction in advance of the transferability repeal. So I think that placed in service standard is, which in the current phase down is really driving decision-making and making sure that not only can we get construction started to lock in transferability, but can we also get the project in service to avoid the phase down. I think, we saw a flurry of begun construction activity at the end of 2024 to lock in 45, 48. We saw a flurry of begun construction activity at the beginning of this year to try and get ahead of any changes. I think we'll continue to see a flurry of begun construction activity. Under the current proposal, the first rules start to kick in for projects, and those are some FEIC rules for projects that don't begin construction within a year of the passage of the bill. So I think we'll see a flurry of begun construction activity to try and get ahead of that. I think that drives some M&A activity. Acquisitions of projects that have locked in begun construction status will become attractive to purchase. So those early development assets that have already started construction. So I think we'll continue to see a lot of activity there, a lot of beginning construction in advance of whatever the first deadline is. But for the most part, I think developers are looking at this reasonably. I think they're looking at it as this was clearly the low watermark. There's no reason to act rashly. There's no reason to, bankrupt the company running out and buying assets to, for the safe harbor at this point, that it's worth waiting and seeing, where this gets by the end of the summer to see if this bill has evolved, how much it has evolved, and what the true deadlines are. So I'll say there's been some cautious optimism and some, thinking into what may need to be planned, but I think a lot of developers are taking there's very little time between now and August. Let's wait and see what we actually end up with instead of acting rashly on first draft that's probably a low watermark.
Yeah, Joe, I want to come over to you on a similar question. I think Hilary flagged the sort of differing standards around projects requiring to be placed in service versus the beginning of construction standard that we've historically seen for phase outs on the legacy credits. From a tax writing perspective, why the change, and would you expect the Senate to potentially approach that change in a different manner?
Yeah, no, I think that's a great question. So as was noted, yeah, phase out based on placement and service is a big departure from how things have traditionally been done, right? Phase outs previously have been triggered by the beginning of construction. Historically, you get the credit rate based on when you begin construction, assuming that you're under continuous construction, right? Most people satisfy that by or through the continuity safe harbor, which ultimately says you're good so long as the project is completed within 4 years after the year construction started. That's been a very workable standard for folks. I think the flip to placement and service, and as a former staffer of one of the tax writing committees, I look at it and say, okay, what is the disconnect with transferability and sort of the phase out, right? Were these both beginning of construction initially? Was the flip purely out of revenue concerns, or why was that put in place? I think placement and service could be workable to the extent you also make sure you really drill down on some of these other rules. I think the big concern, at least the concern I've been hearing, is, okay, what is a world where we're phasing down based on placement and service look like, where simultaneously you're up against you're under the gun on traditional things, right? Making sure you're able to interconnect and do the things you need to with other regulatory bodies on your project, but two, in an environment where you have these FEOC concerns, right? Are you able to make sure your supply chains are in a place where you can, ramp up and get any sort of remaining equipment you need and be in compliance with everything you need to be in compliance with by that accelerated deadline? CODing instead of beginning construction is way more complicated, and I do think that this is going to be a big point of contention and a place where stakeholders really do push heading into Senate consideration to the extent it remains in the bill as is. I mean, at least what we're hearing is, in order to bring on board some of the additional holdouts, there's likely to be further tightening or acceleration of some of these changes. Now, I don't think those will stand ultimately, and is a bit like whack-a-mole, because I think for any one or two House Freedom Caucus members you bring on board, you're potentially losing a couple of moderates, right? So you have to be very careful what you do. But I think the tendency coming out of the House is going to be towards this maximalist approach, right? And then ultimately it's going to be, what does the Senate think is truly workable? That's workable on multiple levels. That's a workable phase out, but workable on some of these other requirements we'll get into.
Great. Alfred, let's move over to transferability. Let's talk a little bit about how the bill proposes that transferability is phased down, and what does project finance end up looking like under the proposed scenarios?
Yeah, so first, Jake, to talk about the present way in which the credits are treated and how transferability works. So presently, the credits extend generally into the 2030s, or in some cases could be interpreted to be beyond, based on a standard that if we as a country have not reached 25% of GHG emissions in 2022, the credits would be presumed to continue for a number of the credits. So there is a current law presumption of a long duration that we have on the continuity of the credits. What the House Ways and Means mark does is phases down sooner. So with many credits ending, fully phasing out by 2031. What they did that is different from the way that transferability is treated and the credits are treated in the current legislation is to separate transferability from the credit year. So many of the credits are phased out over a longer period of time, but they introduced a term where transferability would be repealed after the end of 2027 for projects that had not started by the end of 2027. And that creates a world where you have about 2 years of remaining eligible projects for transferability, including projects in the way that we currently read it that would have started and then produced PTCs over a longer period of time, where they would still be eligible for transferability. But you have a period of time from N27 until whenever the credits go away, where the credits exist but transferability doesn't, which effectively creates a problem or a requirement that whomever is recipient of those credits, the developers and manufacturers that aren't able to use them, would need to monetize them in an alternative way. And generally that would lead people to revert back into the tax equity model. Now that is a workable model and something that for utility, wind and solar, they are well experienced in monetizing their credits through that structure. It is generally only available to the largest projects and not at all available for new credit categories. So in the nuclear industry specifically, it's unclear and unlikely that a partnership can be the owner of a nuclear facility. So tax equity would be a not viable solution for nuclear from 27 or 28 until whenever that credit goes away. There is firmly no market for clean fuels tax equity, advanced manufacturing tax equity. So commercially, that is currently not viable. Presumably that could develop if we were in that reality. But the way that this is presently drafted would drive a ton of value to whomever is able to place those kinds of instruments, those kinds of investments. And it would be presumed that for the market, there would be a real tightening of capital availability for tax-oriented investing. I think in general, if we're looking at how project finance would be changed by any of the changes to transferability, you have an increasingly robust market for different kinds of project finance that are related in some way to the sale of the credits, an increasingly robust bridge lending market, construction lending market that is related to the offtake of the credits. I think in a world where there is uncertainty or transferability is taken away sooner, you would also see those sorts of financing become tighter and less available. And I think that would, again, particularly impact categories like geothermal, nuclear, other things that are reliant on project financing that is underwritten in part by the presence of the transferable credits. So I think we have a baseline here that is more adverse to transferability than the credits themselves. I think the Senate has given indication, particularly senators like Tillis, that this is a known problem. I know that it came up in a meeting that Senator Leader Thune had with the Senate Finance Committee, where it was observed to be a problem in the way that this is currently drafted. And again, like any of these things, I think we're at square two of the progression where there's a lot that remains ahead of us.
Yeah, David, picking up on a few of the points Alfred mentioned. So transferability would be set to expire at the end of 2027. other than in the case of tech neutral credits where the project begins construction within 2 years of enactment of the bill. So it creates sort of this weird mismatch as other panelists have highlighted. Would you expect to see developers trying to safe harbor projects for purposes of preserving transferability? And can you talk a little bit more about the beginning of construction standard? That's obviously a standard we're all familiar with respect to the legacy ITC and PTC. But would it mean the same case? Would it mean the same thing within the context of trying to preserve transferability?
Yeah, a couple of good questions there, and building off of the comments from the other panelists here, which I think were really useful in thinking about this. I mean, of course, I think the imperative is to try and secure the projects as soon as possible, right? And I think we all want to find our way to an investment environment where we have commenced construction in such a way that we are safe harbored for purposes of obtaining the most favorable tax credit outcome. And I think that dynamic is very much in place here. I think there are a couple of things to pay attention to in light of your question, in light of some of the comments. Is one, obviously the different technologies that are credited here have different types of timelines and have different supply chain constraints and so forth. I think it's really important to think about it from your project's perspective, because I think there's a mismatch not only in some of these terms as Hilary and Alfred and Joe laid out, where you have kind of different terms with respect to different credit attributes, but you also have a differential between the investor community and the development community with the members of Congress in terms of what the objectives are here. We want to see an orderly set of incentives that allow the market to, make optimal choices with respect to these investments. There are competing pressures in the drafting of this legislation, where in many respects, what they're simply seeking to do is claw back as much prospective, revenue to the federal government as possible and undermine some of these things. So, this tension is very real, and there was a lot of regulatory development that went into these standards in years past. And I think, in addition to the statutory setup that we have here, there is also, in the wake of any enactment, a regulatory process where Treasury is going to become very important with respect to, the governing nature of some of these terms. And so we want to maintain investor expectations here as much as possible. We want to maintain consistency of language, but also remember that there is this sort of trailing regulatory concern as we advance on some of these things. That, the political pressures here, I think, and I do appreciate that the Senate is going to tackle these things differently than the House will. But for instance, the Freedom Caucus sort of alarm, and the reason that we didn't see a deal move forward as smoothly at the Rules Committee today as we might otherwise have, is that allegedly there was a deal on the tax credit, on the clean energy provisions last night that the Freedom Caucus felt was more favorable. That is, it restricted those credits more than what came out of the Ways and Means Committee. The speaker and his team, under pressure from other elements of the conference, pulled that back. And this is what, Freedom Caucus Chairman Andy Harris says in his remarks. And so they allegedly pulled that back, which led to part of this eruption here. And so these terms and these deadlines are very much still in flux. On the flip side too, don't forget, for people who are in the development community, I know it's easy to get tracked into sort of, this is what's relevant for my project and this is what's relevant for my, financing here. The function of transferability is also important for big companies that are facing international tax complications related to Pillar 2 and the OECD process. And so the facet of transferability is not just a financing tool here in the United States, but is also a form of insurance on the international stage. And so we had, I think there are elements of the community here that want to protect transferability for that purpose, independent of the energy investment attributes of the underlying credit. And I think that tension hasn't fully worked itself out. The Ways and Means folks will say, well, we have, retaliatory international tax measures in there. As a result, you don't have to worry about that. And I don't think that's a sufficient answer for many of the big companies that are in this space who are thinking about that particular facet here. So I think there's additional pressures that I think will be effective in the Senate that are independent of the energy community and independent of the development community.
Great, thanks, David. Hilary, I want to come back to you. So there's been a lot of discussion about the FEOC provisions, including in the chat. So we've seen the new definitions for prohibited foreign entity, specific foreign entity, and foreign influence entity. Can you talk to us a little bit about how these definitions work and just generally how the new FEOC provisions are intended to apply to energy credits?
Sure, happy to cover them. And I think one thing I'd say from the outset is there's been pretty much universal agreement that these rules are poorly drafted and relatively unadministrable. I think they're going to need regulations. I think there's some questions around whether, with the brain drain at Treasury, is there anyone around to write those regs? When we had a fully staffed Treasury, it took them 2 years to get out regs on, similar provisions related to other credits. Now we've got, a fraction of the staff and all of those brilliant minds gone. So it's hard to see how they would, get regs out any faster than that. So I think there's, I think all of that leads to a policy question. And as we heard from Joe, that's something that the Senate's going to be concerned with. They've always been interested in the policy side of things and making sure that they're getting policy right. I think we contrast that with the House, that they're running for re-election every 2 years, so everything's a political question in the House. But I do think when we get to the Senate, there's a good chance that rational minds will prevail. People will take a hard look at these rules and realize that they're not really workable. But that said, we'll talk about them anyway because we've got them. And I think it's helpful to think about them and kind of the buckets they fall into. There are different rules there's rules that are project specific and then rules that apply at the entity level. So when we're talking about the project rules, we're talking about the material assistance rules. And another thing I'll say is that each of these rules have different enacting legislation or enacting language. So for example, the material assistance rule that applies at the project level has a begun construction standard. It applies to projects that don't begin construction within 1 year after enactment. The rest of these rules do not have a begun construction standard. They apply for, if they're applied in the first taxable year after enactment, if they're applied 2 years after enactment, they apply, strictly based on the tax year, not based on begun construction, unless the begun construction standard is applied like it is in the case of the material assistance rules. So I think that's one thing that people have been getting a little confused about, is whether we have a begun construction standard for all of this. The answer is we don't. I think another thing that's been a big question is, for the ones that we don't, what about 45 and 48? Well, so, some of these rules are imposed through a change to Section 50, which has the recapture rules. Those rules only apply to the tech neutral credits, so we don't have an impact on 45 and 48 with those rules. So now digging into what each of these rules are. So we talked a little bit about what applies at the project level. At the project level, we have the material assistance rules. Project can't have material assistance from a prohibited foreign entity. So prohibited foreign entity is basically any entity. It's a pretty broad term. It covers entities with ties to China, Russia, North Korea, Iran. You can read about what those percents are. That's something that might change, so I won't get too into the weeds on it. And basically what it says is that you can't have material assistance from prohibited foreign entity. So this means that you can't acquire things from prohibited foreign entities. There are some exceptions to this. The exception is a little bit unworkable. It's pretty hard. There are a number of boxes that need to be checked. It applies to both components. You have to look at the components. You have to look at the critical minerals. So that is the material foreign assistance that applies at the project level. The second set of rules are entity rules, the rules that apply to the taxpayer, that say you can't claim tax credits if you are one of these types of entities, or if you make a payment to certain type, a payment not for goods to certain types of entities. So these are your specified foreign entity. These are your foreign influenced entity rules. So these are the ones that are going to apply without the begun construction standard. So that's the big difference in the two sets of rules at the project level and at the entity level.
Great. So I want to skip down to sort of what's ahead. I know we're running short on time and want to make sure and leave a couple minutes for questions. So David, maybe we'll circle back on sort of the state of play you provided about the House at the top of the call, and help us sort of understand what happens next, and what do you think the anticipated outcome of the bill would be? And I may even ask you to give sort of a timing prediction.
Yeah, sure. The $1 million question. So in just basic House procedural rules, as I mentioned at the top, legislation typically is considered on the House floor under what's known as a rule. And a special rule, you pass the special rule, and the rule then sets forth the procedural constraints for considering the substantive legislation. So the Rules Committee receives the underlying legislation, crafts a special rule for its consideration by the whole House, and that rule is then considered, approved, and then the underlying bill is considered and approved. We're at that Rules Committee process point. And so we need to finish a rule to govern the underlying consideration, and then pass that immediately, then turn to the substantive bill and pass that. As a theoretical rules matter, that's reasonably straightforward. That is what the House does all the time. You can do that very quickly. You set forth how many amendments are, going to be considered, and the nature of those amendments and so forth. But essentially, you do the rule and you turn to the bill, and it can all be conducted within, an hour. There was a great legislative director for Senator Durbin for many years. Now she's Schatz's chief of staff, but she would always bring up these briefings. With agreement, all things are possible. And it is true, all things are possible, and it could be very quickly. Right now, however, because they don't have agreement on the substantive underlying provisions, this process has effectively stalled out. So Chip Roy, one of the leaders of the Freedom Caucus earlier today, said that we're a, quote, long way away from being done. It is unclear what the final lines are that the Freedom Caucus will demand. And if they achieve those under, guidance from the White House in this negotiated process, if the other factions of the House Republican conference that we outlined earlier will go along with it. And so that's the standoff we're at. They're meeting at the White House at 3:00 this afternoon. These discussions are going to continue through the day and into the afternoon and evening. The Memorial Day deadline does drive decision-making process. There's always said in Capitol Hill that jet fumes, when the members can smell the jet fumes, they quickly move to the substance of the matter. And so there is sort of a psychological deadline that will push them forward, especially since they know they can kick this can of worms over to the Senate and move things forward. So I do anticipate that they reach a deal probably later today that may set up consideration of this bill on Thursday or perhaps Friday in the House, and then it'll move over to the Senate.
Joe, I think you gave us a good prediction in terms of the go forward process for the Senate at the top of the call. But you did allude to kind of how timing would work in the Senate, whether they run a full process through committee, et cetera. Can you dig into that a little bit deeper to sort of help us understand what timing on the Senate side might look like?
Yeah, sure. So I think maybe too, in informing this analysis is at least earlier, I guess I'm living in a time warp, but it was either this week or last week, Senator Ron Johnson came out and said he could not support the bill as written right now. And that is important because Senator Ron Johnson is on the Senate Finance Committee. Republicans agreed to a 1-seat majority on the Finance Committee this Congress. So ultimately, to the extent he is a no, that sort of takes a full Senate markup off the table. And so that too will inform the process, right? So assuming whatever emerges from this House process becomes acceptable to Senator Johnson, I think there are a couple ways this can go. Ultimately, this process is unique now because normally, each senator enjoys way more control over what is happening in substantive legislation. Given the margins we've talked about in the House, right? Each House member gets to be a senator this time around. And so the question becomes for Senate leadership, is it easier to manage this as a sort of 53-member enterprise where, it's sort of people have to take the good and the bad, and we're not being as granular as we consider it, which I think would argue in favor of sort of avoiding a committee markup by the instructed committees. And I think as a result, that's probably the more efficient way of doing it. That said, I do think senators have in the back of their minds that really they have until August, and it is incumbent upon them to ensure that some of these thornier policies are being written correctly. As Alfred alluded to earlier, right? A lot of plank walking that's being expected today on Medicaid and other hot button political issues, right, may change significantly. And that's the refrain we've heard from a lot of the more moderate House members is like, why are you making me vote for this? I know the Senate is just going to change it. And so I think we're going to see them try to manage that process as best they can. I think it is more manageable when you sort of take on the body as a whole. And so I think as a result, they'll probably do that. The July 4th deadline, while probably somewhat motivating, I don't know at the end of the day that really matters. Senators are gonna be back, and I think at least in my experience in the Senate, as motivating as jet fumes are generally, if it is the one thing standing in between the senators and their August recess, it will get done, right? And so I think just the threat of keeping them in as long as it takes will result in a lot of the opposition falling away to the extent it's not genuine. So. I think in this area, right, a lot of the opposition is genuine, and as a result, I think this is going to be hardly fought and ultimately subject to many iterations here over the coming weeks.
Great. So final question before Q&A, and this one is for each of you, and I'm going to ask for a 30-second or less response. But what is one piece of advice for market participants navigating the political process ahead? I'll start with you, Hilary. You're on mute.
So yeah, I mean, I think my number one piece of advice is probably just chill out. We're not there yet. This is going to be a long process, and until we get closer to looking at something that can be agreed by all sides, it's important to keep in mind that, what we have is probably not reasonably likely to be enacted in its current form. So, probably doesn't make sense to be making rash decisions based on something that's not going to get enacted. And it's just kind of taking a deep breath and letting the process play out.
David?
It's really important to remember in a political dynamic like this that politics from a congressional or senatorial perspective are inherently local. If you haven't figured out who your key office's district director is, member of Congress, Senate state director, senator, gotta figure those folks out. They are making national decisions that are going to affect your local conditions. You've got to engage with them.
Joe, you next.
Well, hey, those are the two things I'm most fond of saying to my clients is chill out and all politics is local. I do think that at the end of the day, just to build on what David said, this is very much local. People care about what's happening in their state. You know, if you're in the Senate, with what's happening in their states or in their districts, and there is really no barrier to you going in and talking to these members, right? I think a lot of times people forget and they think, oh, I need to engage someone to assist me in this process. No, you literally can reach out to your elected representatives and talk to them, and they will meet with you, right? And maybe you alone won't move the needle, but if they hear it from enough people, it will. And so I would just encourage people to not shy away from reaching out. You will be heard.
Great. Alfred?
Yeah, I'll just add to that. So there are so many aspects of the bills that are being considered that are highly technical, that influence different projects in different ways. And these members are trying to navigate all of this stuff at the same time. SALT, Medicaid, lots of different changes to the IRA tax credits, and they will have the level of altitude that they have is many tens of thousands of feet higher than the one that you will have. And so as you're dealing with how your project would be impacted by transferability going away after 2027 or FIAC or whatever, going in and talking to the members specifically about that and staff specifically about that is really important right now as we move into a process where we move from a political exercise into actually trying to get to workable legislation, hopefully with the Senate leading the charge on that. So agree with Hilary, chill out, agree with David and Joe, go make your voices heard. People that are actually putting steel in the ground are by far the most productive advocates with their political representatives than anybody else out there.
Great. So maybe time for one or two questions. Lots of questions in the chat. Many relate to FIAC, which I think were largely covered by Hilary's explanation. This is a good one for you, Hilary. One of the attendees asked, for projects that have already been placed in service from a tax perspective, will there be any impact to either the base or bonus PTCs during 2028 to 2034?
No. So if projects already placed in service, already claim tax credits under 4548, no, those are generally, and that's what we talk about, that the good news is we didn't get any kind of a retroactive repeal. All these projects that are already claiming 45 and 48 credits are, for solar, wind, storage, are not affected by these new rules.
Great. Alfred, I think this is a good one for you. Is there likelihood of the repeal of transferability being extended any further beyond the end of 2027? Is that being actively campaigned on by any players with enough influence?
For sure. So it's been about 6 years that have passed in the 6 days since the Ways and Means Committee dropped their text. The concept of transferability being divorced from the credit date is a new concept. It is unclear whether that makes any sense as a legislative or procedural or commercial matter. Lots of people are making their voices heard on that. 41 members of the House Republican Conference have signed on to letters that advocate for transferability in some form or another. And it's expected that the Senate will take a fully novel look at the treatment of all of the credits and transferability. But also, make your voice heard if that matters to you.
If I could chime in, the folks at Ways and Means and Finance, when creating, transferability, did that as a way to widen the ability to invest in these projects. Absent some sort of failure of that project, I don't see why right, left, or center, you'd want to restrict things so that it made, it incumbent on these projects to focus on very expensive consultants and lawyers and, limit the pool of investors and so forth. So Congress tends to keep going with things that are working. And I think you're going to see that here too.
Excellent. Thank you, David. So we're at time. Thanks to everybody for joining us today. We're obviously expecting more news over the next day or so. We'll continue to share more information on social media and through email as it becomes available. We'll also share the recording of this webinar along with the transcript later today. I just want to say thank you to all of our panelists for joining us today and for sharing these great insights. Thank you.
Thanks all.
Thank you.